Alright, now that you have an overview of what is marine insurance, now let us go to the thorough discussions of its salient features. So now let us define what is marine insurance. When we say marine insurance, it is also called as a transportation insurance, which is an important part of the property insurance. So it is concerned with the perils of the property in or incidental to transit as opposed to property perils at a generally fixed location. So the term does not include normal motor vehicle insurance, which is treated separately by law. So now what are the coverage or what are the insurance against loss or damage covered by marine insurance? First, we have the vessels, goods, freight, cargo, merchandise, profits, money, valuable papers, bottomry and respondentia, and interest in respect to all risks or perils of navigation. So the cargo can be the subject of marine insurance, and once it is entered into, the implied warranty of seaworthiness immediately attaches to whoever is insuring the cargo, whether he be the ship owner or not. So later on, we will be talking more of the seaworthiness of a vessel. We also have the persons or property in connection with marine insurance. Next, we have the precious stones, jewels, jewelry, and precious metals, whether in course of transportation or otherwise. And next, you have the bridges, tunnels, piers, docks, or other aids to navigation and transportation. And finally, we have the marine protection and indemnity insurance. So later on, we will have a thorough discussion of these damages and losses covered by marine insurance. So as you can see, it is broad, no? Because it has so many losses or damages covered under this insurance. Okay, so we have major divisions of transportation insurance or the marine insurance. We have two actually. First, we have the ocean marine insurance. So when we say ocean marine insurance, it is one of the oldest written forms of insurance and has to do primarily with the insurance of sea perils. So the old law defines marine insurance, or the term used for ocean marine insurance, as an insurance against risk connected with navigation to which a ship, cargo, freightage, profits, or other insurable interest in movable property may be exposed during a certain voyage or a fixed period of time. So basically, it is more concerned with the navigation or the goods which are being in transit at sea or during navigation or a voyage. The second one is the inland marine insurance. So this one is a comparatively recent origin and covers primarily the land or over the land transportation perils of property shipped by railroads, motor trucks, airplanes, and other means of transportation. It also covers risks of lake, river, or other inland waterway transportation and other waterborne borne perils outside of those risks that fall definitely within the ocean marine category. So it is more broad, the inland marine insurance. So now let's go to the scope of ocean marine insurance. So the first type of or the first division of a marine or transportation insurance. So the ocean marine insurance provides protection for, first we have the ships or hulls. Second, we have the goods or cargoes. Then we also have the earnings such as freight, passage money, commissions or profits. And fourth is the liability, known as the protection and indemnity insurance, incurred by the owner of any party interested in or responsible for the insured property by reason of maritime peril. So in ocean marine insurance, it is only limited to these categories or scope. So there are only four identified. Now, what are the risks or losses covered in ocean marine insurance? So, all risks or losses may be insured against, except such as are repugnant to public policy or positively prohibited. So, everything except those which are against public policy or those prohibited by the law. Okay, so a general marine insurance policy which does not state the risks assured is valid and covers the usual marine risks. And in a policy, the general enumeration of all other perils extends only to marine damage of like kind of those enumerated. So of course, to sustain a recovery on marine policy, the loss must be occasioned by a risk or peril insured against. Thus, so first we have the contract of insurance on freight is that the perils insured against shall not prevent the ship from earning full freight for the insured in that voyage, such as a contract does not undertake that the goods shall be delivered in a sound or merchantable state, or that the vessel shall be safe from the danger of the sea. Next, the underwriter of a vessel does not undertake for the cargo but engages only for the ability of the vessel to perform her voyage and to bear damage which the vessel may sustain in making the voyage. So basically, the underwriter does not undertake the cargo but its ability of the vessel to perform the voyage. Next, we have an insurance on time by no means contains an engagement that any particular voyage undertaken by the insured within the prescribed period shall be performed before the expiration of the policy, but only that the ship shall be capable of performing the voyage undertaken, notwithstanding any loss or injury which may occur to her during the time for which she is insured. Number 4. So in marine policies, as in other kinds of insurance, the insurer may exempt liability from certain causes. Thus, under a marine policy, excluding coverage for breakage unless caused by an accident to the vessel, it has been held that bad weather causing damage is not an accident within the policy. So, the insurer has the freedom to exempt liability from certain causes. So now it depends upon the discretion of the insurer. What are those exceptions from liability that he will be incurring in such insurance? Next, it is a well understood and well established rule of marine insurance that the goods are presumed to be shipped under deck that is below the weather deck of the vessel. So basically, when the cargoes or the goods are being shipped, it is understood that they are presumed to be under the deck. So if the goods are shipped on deck, they are not covered by the policy unless special notice of the storage is given to the underwriter and he accepts the enhanced risk. The reason for this presumption is that the deck of vessel is not designed to carry goods. So its primary function is to make the holds watertight and to protect the cargo laden in the holds. Goods carried on deck are subject to weather damage, sea damage, and the hazard of being washed overboard. So ship owners have no legal right to load goods on deck, and if they do, such goods are at the ship owner's risk unless he had obtained the consent of the cargo owner to such storage. So accordingly, underwriters cannot be expected without special notice to assume the risk of goods laden on deck and will be released from their contract if the insured subject is so loaded. There are certain cases, however, which may furnish an exception to this rule. So certain kinds of goods, dangerous in themselves, are by custom and sometimes by law required to be shipped on deck so that they will not endanger the other cargo and can, if the necessity arise, be quickly overthrown overboard. So underwriters are presumed to know of these customs and legal requirements. Now let's go to the distinguishment of perils of the ship from perils of the sea. So when we say perils of the ship, it embraces all kinds of marine casualties and damages done to the ship or goods at sea by a violent action of the winds or waves. Now let's go to the distinguishment of perils of the sea from perils of the ship. So when we say perils of the sea, it embraces all kinds of marine casualty and damages done to ship or goods at sea by violent action of the winds or waves, one that could not be foreseen and not attributable to the fault of anybody. So basically, the perils covered under ocean marine insurance is the perils of the sea. So the phrase perils of the sea or perils of navigation includes only those casualties due to unusual violence or extraordinary action of the wind or the wave. Okay? So the phrase thus embraces all kinds of marine casualties such as shipwreck, foundering, stranding, collision, and every species of damage done to the ship or goods as at sea by the violent action of the wind and waves, or losses occasioned by the jettisoning of cargo if it is made for the purpose of saving a vessel rendered unworthy under the voyage, not through the fault of the captain. Let's go to the perils of the ship. So on the other hand, perils of the ship are losses or damages resulting from natural or inevitable action of the sea. We also have the ordinary wear and tear of the ship, or the negligent failure of the ship owner to provide the vessel with the proper equipment to convey the cargo under ordinary condition. So is rusting of steel pipes a peril of the sea? Rusting of steel pipes in the course of a voyage is a peril of the sea in view of the toll on the cargo of wind, water, and salt condition. So it is a result of such conditions given by the sea. So what are perils of the ship ordinarily covered by marine insurance? The answer is no, unless there is an express stipulation on the policy. Loss due to perils of the ship is not within the coverage of marine insurance. A marine policy in usual form, therefore, includes only perils of the sea and not perils of the ship, and accordingly, marine insurer upon a policy in the usual form is not liable for a loss caused by a peril of the ship. So who must check the seaworthiness of the vessel in marine insurance? Since the law provides for an implied warranty of seaworthiness in every contract of ordinary marine insurance, it becomes the obligation of a cargo owner or insured to look for a reliable common carrier which keeps its vessel in seaworthy condition. So the insured may have no control over the vessel but has full control in the choice of the common carrier that will transport his goods. So therefore, it is the responsibility of the insured that the vessel which will carry its goods or cargo is a reliable one, so which keeps its vessel in seaworthy condition. So what perils are included in all risks policy in marine insurance? A marine insurance policy providing that the insurance was against all risks must be construed as creating a special insurance and extending to the other risks than are usually contemplated, and covers all losses except such as may arise from the fraud of the insured, intentional misconduct on the part of the insured, or otherwise excluded in the policy. So it covers all losses during the voyage, whether arising from a marine peril or not, including pilferage losses during the war. So later on, we will get to know what are the other or what are the conditions wherein all risks policy is being construed or its interpretation. So we also have the Insurer clause. It's also called the Negligence Clause. It's found in a marine insurance policy and provides coverage for all the ship's hulls from loss or damage caused by machinery. So the development of inland marine insurance. So the need for inland transportation insurance. Okay. So the original marine policy primarily furnished insurance against perils while property was on board the vessel, and its development increased the scope of insurance to cover cargo from the time the property left the premises of the shipper until it was delivered to the premises of the consignee. This, of course, also involved coverage while the property was on land during transit. At the same time, the development of the land forms of transportation, such as the railroads, motor trucks, and airplanes, called for insurance against the perils of land transportation only. Thus, inland marine insurance, as separate from ocean marine insurance, originated. So, from the word itself, the inland, this is now covering those which are goods which are in transit on land. Next, we have the extension of inland marine use. So still another surge in the use of inland marine insurance hinged upon the factor of the continuing diffusion of wealth throughout the economy. The ownership of fur coats, of jewelry, of hobby equipment and sporting equipment spread and promoted the widespread use of insurance form designed for these possessors. As business and commerce grew, many activities seemed to be served best by extension of marine insurance or of land marine insurance to cover property while awaiting shipment, while being prepared for shipment, while being processed, and while in storage after shipment. New inland marine insurance protection next came to apply when the act of transportation itself became incidental to the true use of the property involved. The personal use of jewelry or furs, for instance, ordinarily involves no use of transportation agencies. Yet, an inland marine insurance form insures articles of jewelry or furs wherever they may be, even if they're kept within the home of the owner for 12 months of the year. So the flexibility of inland marine rates and coverages. So as the demand for the inland marine insurance coverages developed into a veritable boom, fire and casualty insurers were attracted to the business. Some of the old marine policy were retained, but they were also incorporated in the policy. Features to be found in both fire and casualty policies. Because of the flexibility of the transportation policy, much broader coverage were available under inland marine contracts than could be obtained under the old fire or casualty contracts. The inland marine contract were particularly desirable when they are concentrated values. In case of fur, jewelry, art treasures, and the like, instead of insuring the risks against burglary, fire, and other innumerable specific perils, a single policy covering all risks had tremendous appeal. So when as usually the case, the all risks policy could be obtained for a cost much less than the required for the accumulation of separate policies. The appeal of marine policy to the buyer of insurance was natural. So basically, the inland marine insurance covers almost all. So it is flexible, thus it is more appealable, or it has more appeal um, to those people who have properties being transported. So the broadening of inland marine coverage. So the original coverage under the inland marine insurance gave protection to policyholder in case of loss or damage resulting from the perils of transportation. So the scope was broadened until finally all risks policies were reached and almost unlimited insurance that appears in very many of the inland marine forms. With all risk coverage and with a very free description of transportation, either actual or technical, the transportation element came to involve not only actual transporting, but the technical state of transportation. Marine insurance companies received complaints from casualty and the fire insurance company. So these complaints were resolved in 1933 in the acceptance of the insurance company's definition of insuring powers of marine and transportation underwriters by the National Convention of Insurance Commissioners. So with this, we have the present status of inland marine business. So we have now the definition of what is covered under the inland marine insurance or its classes. We have the property insurance of on goods on transits by railroad, so express, mail, motor truck, aircraft, and partly by water. So the majority of entirely waterborne shipments are covered by ocean marine policies, but protection against the water transit peril is sometimes included under inland marine policies, along with the protection against other contingencies. This protection is logically afforded in inland marine insurance. Next is the property insurance on goods of certain specified types, whether they may be against any peril, even though not in the course of transportation. So an example is a jewelry floater covering all risks. Another is the insurance on goods in the hands of a dry cleaner. Such contracts are much broader policies than could be issued by either fire or casualty insurers. At the time, the definition was adopted, but for which there was a strong demand. Next, we have the property insurance on fixed property, such as bridges, tunnels, and the like. So, on aids to navigation, such as piers, dry docks, and marine railways, and on aids to communication, such as radio, television, commercial equipment. We also have the property insurance on a few of the means of transportation, such as small boats, railroad cars, and the like. The more important exposures of this character are insured by other agencies, such as vessels by the ocean marine departments, airplanes by aviation insurers, and motor vehicles by automobile insurers. And the liability insurance to protect transportation carriers, warehousemen, processors, and other baileys from the consequences of legal responsibility for property of customers while in their custody. So now, it leads us to the classes of inland marine insurance. So we have the property in transit. This provides protection to property frequently exposed to loss while in transportation from one location to another. We also have the Bailey liability insurance for those who have temporary custody of the goods, as mentioned earlier. Those warehousemen, processors, and other bailies. The fixed transportation property. They are also insured because they are held to be an essential part. So this includes the bridges, the tunnels, and other instrumentalities of transportation and communication, although as a matter of fact, they are fixed property. They are so insured because they are held to be an essential part of the transportation system. Marine policies must exclude buildings, their fixtures, fixed contents, and supplies held in storage. They invariably extend to cover more perils than those included in the usual fire policy. In order for a risk to qualify for a marine contract, there must definitely be included some additional marine perils such as collapse, collision, or flood. Finally, we have the floater. So this provides insurance to follow the insured property wherever it may be located, subject always to the territorial limits of the contract. So in inland marine insurance, the term is used in the sense that it is a floater, so it follows the insured wherever it is located. Okay, so I think that's it. So I will now turn you over to our next
Good evening. My topic for today is insurable interest. What is the extent of the insurable interest of the owner the owner of the ship that is covered by a charter party? The owner of the ship has in all cases, an insurable interest in it, even when it has been chartered by one who covenants to pay him its value in case of loss. This is provided that in this case, the insurer shall be liable for only the part that is lost, which the insured cannot recover from the charterer. There are three insurable interests of the ship owner. First is over the vessel to the extent of its value, except that if the insurance is only up to the amount not recoverable from the charterer. Example of this is X is the owner of a ship valued at 10 million pesos. He charters it to Y, who agrees to pay its value in case of loss. So X can still insure the vessel as at its value, which is 10 million pesos. If he does insure it, he can recover 10 million pesos from Y, the charterer. However, if X recovers 4 million from Y, he can still recover the balance of 6 million from the insurer. So the liability of the insurer is subsidiary to that of the charterer. If the amount paid by the insurer is only 5 million pesos, X is entitled to recover the deficiency from Y. The second and third insurable interest of the ship owner is he has also an insurable interest on expected freightage and no insurable interest if he will be compensated by the charterer for the value of the vessel in case of loss. So there are two instances for insurable interest of the cargo owner. One is over the cargo and expected profits. So in over the cargo, there are two effects. So interest in thing involved based on some legal right. So one having a reasonable expectation of profits from the marine adventure may take out an insurance to protect its profits. However, the interest in the goods or adventure out of which the profits are expected to be realized should be a legal interest, although such interest may be contingent, like commission to an agent or consignee. So the owner of the cargo to be carried on a trading voyage has an insurable interest not only on the value of the cargo, but also on the expected profit of the sale that the cargo from the cargo, which is liable to be affected if by any perils of the sea. The second is interest in thing involved based on valuable consideration. So the insured has sufficient interest if it is based on a valuable consideration paid. For instance, one who has made a contract for purchase of property which has been made ready for shipment, although not yet loaded, and who has contracted to sell it. This is based on Section 106, Classes of Insurance, 337, Title 1, which is Marine Insurance. So the profit has an marine insurance profit, which has an insurable interest in the profits. Insurable interest of the charter over the amount he is liable for to the ship owner if the ship is lost or damaged during the voyage. So an example of this is Y charters a vessel with a value of 2 million pesos, which belongs to X. It is stipulated that in case of loss, Y would pay its value, which is 2 million pesos. So in this case, Y may insure the vessel for 2 million pesos as this is the extent of his insurable interest. If the agreement with A is that Y would pay 200,000 for the charter of the vessel, whether the vessel is lost or not, Y's insurable interest is 2,200,000. Suppose the agreement with X is that Y would pay the price of the charter only upon the safe arrival of the vessel to the point of destination. Then Y engages to carry the goods of Z for the price of 300,000. The expected profits of 300,000 exceeded the chartered hire of 200,000 by 100,000. In this case, Y can insure the vessel to the extent of 2,100,000, as that is the extent that he is liable to be indemnified if it is lost. So what is a loan on bottomry or respondentia? A loan on bottomry or respondentia is a loan which, under any condition whatever, the repayment of the sum loaned and of the premium stipulated. So this depends upon the safe arrival of the port of destination of the goods on which it is made, or of the price they may receive in case of accident, shall be considered a loan on bottomry or respondentia. This is also a loan on bottomry when the security is a vessel and respondentia on the security is a cargo. So the difference is that loan on bottomry is more on the vessel itself and respondentia is more on the cargo itself. So his insurable, what is the insurable interest of the owner of the ship hypothecated by the bottomry? His insurable interest is only the excess of its value over the amount secured by bottomry. The obvious reason is that when the vessel hypothecated by the bottomry is lost, the owner need not pay the loan on bottomry, and therefore he is benefited to the extent of the amount of the loan obtained, and actually the loss he suffers is only the difference between the actual value of the vessel and the loan on bottomry. And does the lender have an insurable interest over the vessel hypothecated by bottomry? The answer is that one who lends the money on bottomry or respondentia has insurable interest in the ship or cargo that was hypothecated to the extent of the amount of the loan granted, for the reason that the loss of the vessel of cargo hypothecated by way of bottomry or respondentia produces the extinguishment of the loan, and therefore the lender stands to suffer damage by the loss of the vessel or cargo. That's all, and thank you.
Our next topic is the voyage and deviation. When is the course of the voyage insured? When the voyage contemplated by a marine insurance policy is described by the places of beginning and ending, the course of the voyage insured is A. The one agreed upon by the parties. B. In the absence of agreement, the course of sailing fixed by mercantile usage. C. If the course of sailing is not fixed by mercantile usage, one which to a master of ordinary skill and direction would seem the most natural, direct, and advantageous. What is deviation? Deviation is any unexcused departure from the regular course or route of the insured voyage, or any other act which substantially alters the risk. These are cases of deviation in marine insurance. 1. Departure from the course of sailing fixed by mercantile usage between the places of beginning and ending specified in the policy. 2. Departure from the most natural, direct, and advantageous route between the places specified if the course of sailing is not fixed by mercantile usage. 3. Unreasonable delay in pursuing the voyage. And 4th, the commencement of an entirely different voyage. Deviation could be proper and improper. The following are proper deviation. A. When caused by circumstances over which neither the master nor the owner of the ship has any control. B. When necessary to comply with a warranty or avoid a peril, whether or not the peril is insured against. C. When made in good faith and upon reasonable ground of belief in its necessity to avoid a peril, or when in good faith for the purpose of saving human life or relieving another vessel in distress. Improper deviation is every deviation not specified above. Effect of improper deviation. The insurer becomes immediately absolved from further liability under the policy for losses occurring subsequent to the deviation. The fact that the deviation did not increase the risk or in any wise contribute to the loss suffered is wholly immaterial. Loss. There are two kinds of loss in marine insurance. It could be total loss or partial loss. In total loss, there are two types, actual loss and constructive loss. But we'll first discuss about the actual loss. Actual loss is caused by a total destruction of the thing insured. It could also be the irretrievable loss of the thing by sinking or being broken up, or any damage of the thing which renders it valueless to the owner for the purpose for which he held it, or any other event which effectively deprives the owner of the possession at the port of destination of the thing insured. An actual loss may be presumed from the continued absence of a ship without being heard of. The length of time which is sufficient to raise this presumption depends on the circumstances of the case. The complete physical destruction of the subject matter, as in the case of fire, is not essential to constitute an actual total loss. Such a loss may exist where the form and species of the thing is destroyed, although the materials of which it consisted still exist. There is limited liability rule. It means that the ship owner's or ship agent's liability is usually coextensive with his interest in the vessel, such that a total loss thereof results in its extinction. No abandonment is necessary. As an exception to the limited liability doctrine, a ship owner or ship agent may be held liable for damages when the sinking of the vessel is attributable to the actual fault or negligence of the ship owner or its failure to ensure the seaworthiness of the vessel. The second total loss is the constructive total loss. It is one which gives to a person insured a right to abandon, one in which the loss, although not actually total, is of such a character that the insured is entitled, if he thinks fit, to treat it as total by abandonment. An abandonment becomes necessary in order to recover as for a total loss. The second type of loss in marine insurance is partial loss, which is a loss other than a total loss. Our next topic is about averages. Average is defined by the Code of Commerce as any extraordinary or accidental expense incurred during the voyage for the preservation of the vessel, cargo, or both, and all damages to the vessel and cargo from the time it is loaded and the voyage commences until it ends and the cargo unloaded. These are the kinds of averages. First is the simple or particular average, which includes all expenses and damages caused to the vessel or to her cargo which have not inured to the common benefit and profit of all the persons interested in the vessel and her cargo. It is suffered by and borne alone by the owner of the cargo or of the vessel, as the case may be. Liability of insurer for particular average may be agreed by the parties that the insurance shall be free from particular average, unless such particular average loss is the effect of depriving the insured of the possession at the port of destination of the whole of the thing insured. The second is the general or gross average, which includes all the damages and expenses which are deliberately caused in order to save the vessel, its cargo, or both at the same time from real and known risk. It must be borne equally by all of the interests concerned in the venture. Liability of insurer for general average. He is liable for his proportion of all general average loss assessed upon the thing insured. Principle of general average contribution. A principle of customary law independent of contract, whereby when it is decided by the master of a vessel acting for all the interests concerned to sacrifice any part of a venture exposed to a common and imminent peril in order to save the rest, the interests so saved are compelled to contribute ratably or proportionately to the owner of the interest sacrificed, so that the cost of the sacrifice shall fall equally upon all. Right of a party to claim general average contribution. The requisites to the right to claim general average contribution are: first, there must be a common danger to the vessel or cargo. Second, parts of the vessel or cargo was sacrificed deliberately. Third, the sacrifice must be for the common safety or for the benefit of all. Fourth, it must be made by the master or upon his authority. Fifth, it must not be caused by any fault of the party asking for the contribution. Sixth, it must be successful, in other words, resulted in the saving of the vessel and or cargo. And seventh, it must be necessary. What are the effects of a stipulation that the marine insurance shall be free from particular average? If the damage to the thing insured is a particular average, the insurer shall not be liable unless the loss suffered is total. Example, the insured is deprived of the whole of such thing. Second, if the damage to the thing insured is a general average, the insurer shall be liable whether the loss is partial or total, or for the contribution of the insured for his proportion of all general average losses upon the thing insured which was saved. And that ends my report. Thank you.
Good evening, everyone. Good evening, attorney. Tonight, I will be reporting about abandonment in marine insurance. So first, let us discuss what is abandonment in marine insurance. Abandonment in marine insurance is defined as the act of the insured by which, after a constructive total loss, he declares the relinquishment to the insurer of his interest in the thing insured. So we also have here the requisites for valid abandonment. First, there must be an actual relinquishment by the person insured of his interest in the thing insured. Second, there must be a constructive total loss. The abandonment be neither partial nor conditional. It must be made within a reasonable time after receipt of reliable information of the loss. It must be factual. It must be made by giving notice thereof to the insurer, which may be done orally or in writing, and must specify the particular cause of the abandonment. Abandonment where insurance is divisible. So, if any particular portion of the thing insured separately valued by the policy may be separately abandoned as it is deemed separately insured. Next is abandonment where insurance is indivisible. Indivisible insurance exists where only one premium was paid for only one cause or consideration. An abandonment must be neither partial nor conditional. It must be entire. It must cover the whole interest insured. It must be unconditional, rather, unfettered by contingencies and limitations. Abandonment must be made within a reasonable time after receipt of reliable information of the loss, but where the information is of doubtful character, the insured is entitled to reasonable time to make inquiry. Reliable information of loss. So when is there a reliable information of loss? So if a notice of loss received, which is credible, the insured must elect within a reasonable time whether he will abandon to the insurer, and if he elects to abandon, he must give notice thereof. So double character of information of loss. This happens if the information first received, the character of the loss is not made clearly to appear. The insured is entitled to a sufficient interval to ascertain its real nature. So abandonment must also be factual. The right to abandon depends upon the state of facts at the time of the offer to abandon. The insured cannot abandon when the thing insured is safe, or when the insured knew that at the time of the offer to abandon, the vessel has been repaired and is successfully pursuing her voyage. So here, information need not be direct or sufficient. It is sufficient that the information came from the protest of the master, or a newspaper report, the report of a pilot, or letter from an official or an agent. So how is abandonment made? It is made by giving notice to the insurer, which may be done orally or in writing. If the notice rather be done orally, the insured must submit to the insurer within 7 days a written notice of abandonment. By whom and to whom notice is made? It is made made by an authorized agent, by an agent of the underwriter, by a broker who is agent for both parties. So the notice of abandonment must be explicit. It must not left open as a matter of inference from some equivocal acts. There must be an intention to abandon and relinquishment of rights of the insurer, rights to the insurer rather. So the use of the word abandonment is not necessary. It is sufficient that the expressions were used to inform the insured that the insured has the intention to abandon the property, but there is no abandonment if the insured continues to claim and use the property as his own. So here, it must also specify the intention to abandon, but it must also specify the intention to abandon, but need state only enough to show that there is probable cause. So the grounds for abandonment must be stated with such particularity. So it also need not be accompanied with proof of interest or of loss. So what are the effects of a valid abandonment? So it transfers to the insurer the interest in the subject matter covered by the policy, subject to the rights and interest, and if any, of third persons. The insurer acquires thereby the entire interest insured, together with all its incidents, including rights of action, which the insured has against third persons for the injury. So rights of insurer who pays partial loss as actual total loss. So the insurer here is entitled to whatever may remain of the thing insured or its proceeds or salvage as if there had been a formal abandonment. So transfer of agency to insurer. The captain continues to be the agent of the insured until abandonment. But from the moment of a valid abandonment, the master of the vessel and agents of the insured become the agents of the insurer, and that the insurer now becomes responsible for all their acts in connection with the insured property and for all the expenses and liabilities in respect thereof. Effect of insurer's refusal to accept abandonment of insured's right. So here, an acceptance is in no case necessary if the abandonment is properly made, and that the insured's right to abandon is absolute when justified by the circumstances. Effect of acceptance of abandonment. So if there is acceptance na sa abandonment, the insurer becomes liable for the whole amount of the insurance and also becomes entitled to all rights which insured possessed in the thing insured, fixed the rights of the parties, stops the insurer to rely on any insufficiency in the form, time, or any right of the abandonment. So next, we have here valuation in marine insurance. So a policy insurance may be valued or open. The object of valuation in a policy is to fix in advance the value of the property and thus avoid the necessity of proving its actual value in case of loss. So what are the effects of valuation? The value of the vessel at the end of the voyage may not be the same thing as the beginning. So here, this may happen when a vessel, for example, is insured for a very long time or for a long voyage. So her value at the end of the voyage is not the same as its value from the beginning. So the insured value must be that which is stated in the policy. So when insured becomes a co-insurer. So an insured becomes a co-insurer in marine insurance if the value of his interest exceeds the amount of the insurance. He is considered the co-insurer for an amount determined by the difference between the insurance taken out and the value of the property. So we have here, for example, if a vessel valued at 500,000 pesos is insured for only 400,000 pesos and is damaged to the extent of 250,000 pesos, the insurer will be required to pay 80% of the loss suffered or 200,000. The other 20% or 50,000 pesos being borne by the insurer, by the insured himself. So the insured is co-insurer here for the amount of 50,000, which is so here yun sa insured siya sa amounts of 50,000, which is katong sa 100,000 pesos niya nga uninsured portion. So yun sa to siya pagkuha. We have here a formula. So partial loss divided by value of the thing insured times the amount of insurance is equals to amount of recovery. So here we have 200,000 pesos as the partial loss divided by 500,000 pesos times 400,000 pesos, which is the amount of insurance, is equals to 200,000 pesos, which is the amount of recovery. So next, loss of profits separately insured. So if the profits to be realized are separately insured from the vessel or cargo, the insured is entitled to recover in case of loss such portion of the profits, such portion of the profits as the value of the property lost bears the value of the whole property. So in an example, assuming that the amount of profits insured is 20,000 pesos, the value of the whole cargo from which such profits are expected to be realized is 80,000 pesos, and the value of the goods lost is 48,000 pesos. The insured is entitled to recover 12,000 pesos. So giunsa na siya pagkuha. We have a formula here again. So the value of property loss will be divided to the value of the whole property insured times amount of insurance is equals to the amount of recovery. So we have here 48,000 as the value of the property loss divided by 80,000, the value of the whole property insured times the amount of insurance, which is 20,000 pesos, is equals to 12,000, which is the amount of recovery. So we're only part of a cargo of freightage is insured is exposed to risk, the valuation will be reduced proportionately, and that the insured is bound to return such portion of the premiums as corresponds with the portion of the cargo which had been exposed to risk. So for example, if 200 cavans of rice valued at 160,000 pesos are insured for the same amount for a voyage in a certain vessel and only 50 cavans were actually loaded and shipped in said vessel, in case of total loss, the insured can collect only 1/4 of the entire valuation or 40,000, but the insurer is bound to return the 3/4 of the premium paid by the insured, since 3/4 of the cargo or 150 cavans were not exposed to risk. So presumption of loss of profits. Such loss of the profits is conclusively presumed from the loss of the property, and the valuation agreed upon in the policy fixes the amount of recovery. So again, we have here an example where the value of the profits insured is fixed at 100,000 pesos, and the cargo out of which said profits are expected to arise is completely lost by the peril insured against. The insured can recover the total amount of 100,000. The loss of profits of 100,000 is conclusively presumed from the total loss of the cargo, and the insurer is bound by the valuation. So rules for estimating loss under an open policy of marine insurance. So in estimating a loss under an open policy of marine insurance, these following rules shall be observed. First, the value of the ship is its value at the beginning of the risk, including all articles or charges which add to its permanent value or which are necessary to prepare it for the voyage insured. Second, the value of the cargo is its actual cost to the insured when laden on board, or where the cost cannot be ascertained, its market value at the time and place of lading, adding the charges incurred in purchasing and placing it on board, but without reference to any loss incurred in raising money for its purchase, or to any drawback on its exportation, or to the fluctuation of the market at the port of destination, or to the expenses incurred on the way or on arrival. The value of freightage is the gross freightage, exclusive of primage, without reference to the cost of earning it, and the cost of insurance is in each case to be added to the value thus estimated. So when cargo insured against partial loss is damaged, so it's Section 164 states that if cargo insured against partial loss arrives at the port of destination in a damaged condition, the loss of the insured is deemed to be the same proportion of the value which the market price at the port of the thing so damaged bears the market price it would have brought if sound. So we have here a given formula. So the market price in state minus market price in damaged state is equals to reduction in value, or the depreciation. And then after ANA, it will be the depreciation or reduction in value will be divided to the market price in sound state times amount of insurance is equals to amount of recovery. So in a given example, suppose that goods valued at 500,000 and insured for 300,000 were damaged on the way, so that their market price at the port of destination was only 400,000. Assuming that the market price of the goods would have brought if sound is also 500,000, the amount recoverable is 60,000. So giunsa siya pagkuha. So we have 500,000, which is the market price in sound state, minus 400,000, which is the market price in damaged state, is equals to 100,000, which is the depreciation. And now that the 100,000 will be divided sa 500,000, which is a market price in sound state, times the amount of insurance, which is 300,000, is equals to 60,000 pesos, which is the amount of recovery. So limit as to the liability of the insurer. The liability of the insurer shall be less than the proportion of the general average loss assessed upon the thing insured where its contributing value is more than that the amount of the insurance. The insured also is liable to contribute ratably with the insurer to the indemnity of the general average. So my report ends here. I hope nga naamoy na learn, and thank you.